Every major rotation in global markets begin where investors stop looking. Today, this place is emerging markets, not because they are exciting or popular, but because they have been deeply unloved, deeply discounted. And if history rhymes, early in a new cycle. So, this chart that you're looking at is not a price chart, it is a timing tool. It is something far more powerful. It is a cycle map, stretching back for more than 5 decades, showing when emerging markets quietly reset and when they exploded higher after investors had given up. And once you understand how to read it, you'll never look at global allocation the same way again. So let's understand the chart and then let's analyze the chart. This chart shows two lines, each telling a very different story. The black line these are the lines that I like to use. These are relative lines. So it's basically the emerging markets relative to the developed market. Now, I just want to make sure we understand each other. When we're talking about emerging markets, you're talking about Asia, some South American countries, Taiwan. I mean, small. Let's put it anything having to some countries in Africa, right? We're not talking about developed market. We're not talking about the U.S. We're not talking about Europe. So this black line measures how emerging market perform relative to developed markets, primarily the US. So when the black line is rising, it means that the emerging markets are outperforming the developed markets because it's a relative, basically emerging market versus the US or the developed. So as we're doing better here, and this is not doing so good, then obviously the ratio goes up. When it's falling, emerging markets are being left behind. This is not about an absolute gain. This is about leadership, right? So markets just don't keep going up and up. They rotate, as obviously. And leadership always change after long periods of underperformance. Next, we are looking at the blue line. And the blue line is basically the absolute performance in US dollar terms. Because this is important because a market can rise in absolute terms, but still underperform another market and therefore attract no capital. And you kind of see that it is not doing much of anything. The blue line is kind of straight, which in the emerging markets absolute price. It's absolute versus relative. The actual price is not moving that much. And obviously, as we know, the developed markets moved up a lot, and that's why the ratio went down. So when you look at the this matters, right? Because as we said before, absolute is sometimes very important because you see actually what's actually happening. But this is why investors often miss the emerging market cycles because they look dead relative to U.S. equities, even when they are quietly compounding because the other guy is doing much better. Now, the green line. These dashed green line that you see on top mark cycle trough. Look at the spacings. 7 years, 9 years, 10 years. Okay. And this is when basically emerging market did well. Look how long they did for several years. So they move in a long, grinding cycles that frustrate investors before rewarding patience in violent bursts, the green lines. So this chart is basically telling you that cycles don't die, they reset. Let's take a walk through history because it's, as we always said, history doesn't repeat, but in markets, it absolutely rhymes. So in the 70s, emerging market barely existed as an asset class. But after years of stagnation, inflation shocks, currency stress, emerging market assets quietly began outperforming. First, capital trickled and then it flooded, as you could see. The 70s, it was nothing going on, and we're looking at 76, 78, 79, all the way up to the 80s on the left side of the chart. Then you've got the first collapse, late 80s to early 90s, right? By the late 80s, EM had become overowned. Then you've got the debt crisis, the currency breaking, the capital flight, the black line collapses. Investors declare emerging market uninvestable. Boom. So now we're dropping. This is the first drop to the left. Then in the mid 90s to the late 90s, the next boom. Something critical happens here. Valuation reset, capital costs fall, productivity surges. The black line explodes higher again. Look how far it goes, even further up from the 70s. Boom, the black line explodes. EM outperforms dramatically until the Asian financial crisis ends the cycle. Once again, investors exit at the bottom. That's what they usually do, and hopefully that doesn't happen to you. And that's why I want you to join this channel and become a member. So every day I explain to you what's going on and you learn about these complicated markets. You're living in a world that needs to be understood, not followed, right? Not looked at. You need to understand. So then, of course, after the bottom, we have the 2011, the golden age of EM. This is a cycle everyone remembers. China joins the WTO, the World Trade Organization, and of course, over the next 20 years, China is essentially going to learn how to make everything. Medication, medicine, solar panels, shoes and t-shirts, but more importantly, biotech, the rare earth, right? Everything. So commodity supercycle ignites and the dollar weakens. It starts the weakening. Emerging markets dominate global returns. Look at the second one, even higher, almost quite as high as the second one. And look at the black line. This is incremental outperformance. This is regime dominance. And then it ends, of course. 2011 to 2024 is the last decade. Now, look at the right side of the chart. This is the part investors are living through and emotionally scarred by the strong dollar, U.S. tech dominance, capital concentration, and the emerging market political risk. And the black line collapses again. For more than a decade, emerging markets underperform relentlessly. And this is not a noise, this is cycle compression. And historically, this phase always precedes a reset. So, what is the key insight? Everyone misses. Here's the most important point. Emerging markets don't bottom when things improve. They bottom when narratives are exhausted. Look at the far right of the chart. The black line is deeply depressed, near historical extremes. See that? I mean, this is almost the lowest it's been, the black line. And right next to it, the annotation. EM cycle starting again. It doesn't mean price goes straight up tomorrow. It means the conditions that precede long-term performance are now in place. Extreme relative undervaluation, capital underallocation, dollar cycle fatigue, and U.S. concentration risk. Markets rotate not because of optimism, but because the return demands it. So what does this matter now? What is the big deal? Why do we need to worry about this? Well, U.S. market concentration risk, developed market, especially the U.S., are dominated by a narrow set of mega cap, Magnificent Seven. That concentration historically ends with a crash, but with relative underperformance. Dollar regime risk. Emerging markets suffer during strong dollar regimes. But dollar strength is cyclical, not permanent. Every sustainable EM cycle in this chart coincides with a dollar stabilization or decline, and the dollar is declining. And of course, your valuation, the valuation gravity. Valuations matter, not day to day, but over decades. Emerging markets are priced for lower expectations, higher risk, minimal growth. That is exactly when long cycles begin. So, what does this mean for the investor? What does it mean for you? Go all in on EM. No, it doesn't say that. It says diversification will matter again. Relative returns will rotate and capital will move where it has been absent. The biggest mistake investors make is waiting for confirmation. You always wait for the confirmation. By the time confirmation arrives, most of the relative gains are gone and cyclical reward are over. Let me leave you with this. Emerging markets don't need perfection. They only need less disappointment. And according to half a century of data, when disappointment peaks, cycles reset. This chart is a warning. This chart is a warning. And most of investors ignore is that you buy when everyone else is selling. Now it's time to buy. Because all the conditions are there. Learn the cycle, understand the cycle, know what's going on so you could take action. It is very key for you to realize that the way you make money in the stock market is by first understanding the most important fact, which is you need to worry about risk. You need to worry about volatility. And that's why we're seeing all these charts are going up and down all the time. That's why we look at the relative risk. Did you look and left and the right side of the street before crossing? Or you just want to cross the street? Also, remember, correlation is not causation. Just because something happened in the market, like Kevin Walsh has been nominated and he supposedly wants a strong dollar and gold happens to drop, doesn't mean that, one is causing the other. You need to be educated. That is more important.